there is always volatility involved in markets as well. And the market's job is to try and throw you off. Right now, generally speaking, most people have missed the massive rally in equities. And so they're hoping that the market comes lower. So we've seen that from the institutional surveys. People just haven't been involved. So a lot of it's been retail and passive money, index funds, stuff like that, without people actually making money from it. And that's always interesting to me because we come into year end and it tends to mean that somebody's going to have to make a decision how they want to report to their investors at the end of the year. And the pension funds and others don't want to show that they were massively underweight equities all year. But let's see how that plays out. I've got some strong views about the rest of this year as well.
A key recession indicator isn't signaling a downturn this time, according to Goldman Sachs. The inversion of the yield curve when short-dated treasuries offer a higher return than longer-term treasury is typically seen by investors as a sign of looming economic weakness. That's because banks, which make money by borrowing bonds at typically low short-term rates and lend them out to businesses at higher long-term rates, have little motive to lend when short-term rates are so high. However, the global economy proved more resilient than expected in the first half of 2023, but the growth outlook remains weak. With monetary policy becoming increasingly visible and a weaker than expected recovery in China, global growth in 2024 is projected to be lower than in 2023. While headline inflation has been declining, core inflation remains persistent, driven by the services sector and still relatively tight labor markets. Risks continue to be tilted to the downside. Inflation could continue to prove more persistent than anticipated, with further disruptions to energy and food markets still possible. A sharper slowdown in China would drag on growth around the world even further. Public debt remains elevated in many countries. Let us now join Raoul as he takes us on a journey of inflation and recession and why he still maintains a positive stance despite all. As you watch, don't forget to hit the like button, subscribe, and drop your comments below.
You never trade today's news. You need to understand which part of the cycle is driving the asset prices and which part of the cycle is driving the Federal Reserve. So on this, myself and Julian Bittle, who works with me, Global Macro Investor, well, our job is to live as far out as possible. So we're in that 8 to 10 months area ahead where we're looking what's happening to the cycle. We actually go further out, but the bulk of our business cycle work, as opposed to our secular work, is this 8 to 10 months out. Now, the markets have been roughly trading 2 to 4 months ahead of the business cycle. In some cases, stuff like technology and crypto, they've actually been even further ahead than normal. And then we've got the central bank. Well, they're lagging with the ISM. If we take the ISM as where the economy is today, because it's basically a real-time GDP indicator, well, the central banks, well, they're looking for CPI to come down and unemployment. And those things are really lagged. In some cases, 6 to 8 months. And when we get down to the big inflation stuff like shelter inflation and wages, I mean, they can be over a year, sometimes 2 years lagged as that keeps changing. So, okay, that's now you understand where we are. So let's look at right now, the ISM. The ISM gives you the snapshot of where we are. And it's been around this kind of 46, 47 level for a while now. Now, that's a really important level because historically, that has pretty much had a 100% chance of recession. And I think most of us realize we've had a recession. I think most businesses have seen a slowdown. I think many people have laid off jobs, and we're seeing, and I'll come on to jobs later, a change in the job structure. But that recession has not been called yet. We've seen the economic data, the GDP data, still somewhat buoyant. But I think it's there, and I think when all is said and done, the recession will have been called during this year. But here's the rub. I think it's actually about to start becoming over. Now, again, I'm using the ISM. The ISM leads GDP because that's lagged by 3 months. So therefore, by the time the ISM gets positive, which I think is coming, and I'll show you that in a sec, that's all going to play out kind of Q1, Q4 to Q1. But the point being is we are at the trough of the actual cycle right now. So if we look at what we use as our main indicator, the GMI Financial Conditions Index, it has a 9-month lead. Now, this Financial Conditions Index is a blend of the dollar, commodity prices, and rates. Now, it led It led the whole cycle, suggested the ISM is going to recover by a significant portion of time. It also gave us the trough 9 months prior. So we've known roughly when the ISM was going to trough from using our indicator a long time ago, and that what that was going to do to financial markets. You can see, interestingly now, it's rolling over somewhat. That's based on the fact that the dollar's gone up recently and rates went up recently. So it tells us something that we may see growth slow down or have a soft patch later in 2025. But anyway, let's not get ahead of ourselves. We're focusing on now, boom, bust. It's that crash, or are we in a next bull market idea that I want to go through.
Headline inflation has continued to come down in many countries, driven by the decline of food and energy prices in the first half of 2023. However, core inflation excluding the most volatile components, energy and food, hasn't significantly slowed. It remains well above central banks' targets. A key risk is that inflation could continue to prove more persistent than expected, which would mean interest rates need to tighten further or remain higher for longer. According to Raoul, the recession rises may have been too exaggerated and won't be as bad as people make it out to be. He further shares his opinion as we go on in the video.
We did have real inflation from the supply issues. They were real structural, well, not structural, cyclical things that were one-offs. And that's now unwinding. So one of the things that's really driving inflation, or the core inflation, the stickiness of core inflation, if you remember, when we look at those dominoes, the furthest domino back is shelter. Because shelter's incredibly lagging, even how it's calculated. So when we use the Case-Shiller Home Price Index, it's already unwound all of the inflation. It's at 0%. And that would suggest CPI shelter is also going to head down by 2025 to maybe 2%, maybe less. So this is yesterday's story, and this is going to continue to play out. And I think when the Fed get to cutting rates, they'll be cutting rates longer, as they always do after a recession, because the core lags the headline inflation, and they will focus on the core to get it down as low as possible. And before you know it, they overshoot. So they are going to be cutting rates as they see it coming down. Now, the other thing is wages. So wages have started deflating massively. Here's our wage growth tracker index at GMI. It's an 11-month lead, and the Atlanta Fed version, and it's just coming lower. So wages are coming down, rents are coming down, inflation, core inflation, because these are the stickiest parts, are going to keep coming down. So I don't know where this interest rate shock is going to come from. I understand there is a supply issue in rates right now, and that's probably keeping rates higher. I understand about the deficit. I understand about financing of rates, but we'll come on to that in a minute and how that's going to play out. So when I take out shelter from CPI, it already shows CPI at 1%. So the inflation story is over. Yes, commodities will rally somewhat at this point in the cycle, but to generate significant inflation, considering commodities are like 17% of CPI, you need a hell of a big move in commodities for it to even appear in this. And there's always a cyclical uptick in headline inflation before core inflation stops falling. Our view at GMI is we probably hit somewhere close to zero in headline inflation this year, and we probably hit zero or less in core next year. So therefore, we think that the central bank is going to be much more active than people anticipate. The other thing people talk about a lot is there's going to be a credit crunch and the market's going to crash. We've all seen the banking situation. I get it. There is a credit problem. And you see, if we look at bank lending year on year, it's starting to go lower. Of course it is, with that point of the cycle. But if we look at the lending standards, which leads it, it's already been pricing this in for a while now. And equities, I think, have already priced this in. Doesn't mean that bank lending's not going to slow down, but it means that the market's going to look through this, because what you find is bank lending standards is basically ISM. And if we think ISM is rising or starting to rise, well, then lending standards themselves will, and eventually bank lending itself will bottom out in a long time. So if bank lending is still contracting, but the economy's growing, the Fed will be more prone to action, continued action, when they start looking at these lagging things. Leads, lags, so important. Really, really important to understand.
The Organization for Economic Cooperation and Development, OECD, on Tuesday raised its world economic growth forecast for 2023, but lowered it for 2024. The world economy is expected to grow by 3% this year, said the Paris-based organization in its September Global Economic Outlook report. This was 0.3 percentage point upward from the previous projection in June. The global gross domestic product, GDP, growth is foreseen to come in at 2.7% next year, revised downward by 0.2 points. With monetary policy becoming increasingly visible and a weaker than expected recovery in China, global growth in 2024 is projected to be lower than in 2023, the OECD said. The GDP in the U.S. is expected to increase 2.2% this year, revised upward by 0.6 points. The growth is expected to slow to 1.3% in 2024 as tighter financial conditions soften demand pressures. The OECD cut China's growth forecast by 0.3 points to 5.1% for 2023 and 0.5 points to 4.6% for next year, led by subdued domestic demand and structural stresses in property markets. The OECD forecast Eurozone GDP growth to ease to 0.6% in 2023 and edge up to 1.1% in 2024 as the adverse impact of high inflation on real incomes fades. It stressed that the headline inflation continued to decrease while core inflation, excluding the most volatile components, energy and food, remained persistent, led by the services sector and tight labor markets. Inflation in the G20 is projected to ease to 6% this year and 4.8% next year, with core inflation in the G20 advanced economies declining from 4.3% in 2023 to 2.8% in 2024. What do you think of the government's reaction so far to the changing economic landscape? Let us know your thoughts in the comment section, and also don't forget to like, subscribe, and drop your comments below. Thanks for watching.